Hello and welcome to the latest edition of Citrus Mortgage Bites, live from our offices in Sevenoaks. So the Bank of England have just announced their decision today to reduce the Bank of England base rate by 25 basis points from 4.75 to 4.5%. This was widely anticipated. And I think the Monetary Policy Committee were unanimous actually in their decision. It was 7-2 to vote for the 25 basis points drop. What does that mean if you're a borrower and thinking, great, maybe I've got lower mortgage payments? Well, I guess it depends what type of mortgage you're on, but typically for a borrower on a tracker rate mortgage that tracks the Bank of England base rate, £125,000 mortgage over 25 years on a repayment basis. Typically, that means £17 a month reduction in your mortgage payment, but lenders will be confirming kind of what that means to you individually, when it's from, etc., depending on the product that you have. So that's a bit about today's rate. Now, why was it perhaps not a surprise? Why was such an overwhelming majority of experts actually saying, well, we're going to see a drop today? For those of you that have seen the recent Citrus Bites are recorded, actually I talked through, inflationary pressures are easing at a slightly better rate or faster rate than anticipated, getting towards the Bank of England target of 2%. So that's the first thing. And inflation was a really important metric. The second one we've got is unemployment going up slightly in the UK. That would indicate that the jobs market is cooling a little bit. And the third point is you put that together and real wages. So real wages I talked about, which is where you've got inflation busting pay rises coming out, which sort of creates this spiral on inflation. The jaws, which are how much is inflation going up by and how much our pay rise is going up by, the sort of real value of a pay rise. We're starting to see the pressure cooling on those pay awards, which is likely to mean that pay awards start to be suppressed moving forward as well. So all of that is beginning to cool that inflationary metric. Indeed, the services inflation, which is really key for the UK because we're such a services economy, that's I think at a 33-month low now. So last seen sort of March 2022. So there we go. This is the third rate reduction in this current cycle of reductions by the Bank of England, and for reasons that were hotly anticipated. However, there's a few other bits playing out I just want to talk about briefly, because I think these are really important. Because actually, until recently, perhaps over the last few weeks, this reduction was sometimes kind of in the balance, actually. And why is that happening? And this is to do with a couple of areas I'll just catch on very briefly today. One, really the government fiscal policy. So this is a couple of changes announced by Rachel Reeves in the October budget, but looking at changes to employers' national insurance contribution. You've probably read about this a lot, but this is going up in the new tax year from 13.8 to 15%. Now, why does that cause a threat to interest rates? Well, it causes a threat to inflation, and higher inflation typically results in higher interest rates to cool the economy. And by putting the rate of national insurance for employers up, it is very likely in a number of scenarios that extra cost to employers will be passed on to consumers by way of pay, by way of cost for those products or services. So we're going to see people paying more, and all of that sort of potentially fuels that inflation. So that was a real concern. The second one, of course, and perhaps at this stage it's too early to tell, I would suggest. So you've seen quite a lot of big corporate employers, big employers coming out, making actual redundancy announcements on the back of their trying to reduce costs ahead of this change of NI coming in. The second thing is Trump tariffs. A lot of noise about Trump tariffs, and actually the reality is I think it's just too early to tell at the moment what might happen. And therefore, at the moment, if you use data to make decisions, which the Bank of England have typically said they are data-driven in their decision-making, it's too early to tell whether some of Trump tariffs will actually cause any inflationary pressures. And I'll talk about that in more detail at another time. So that was a risk. We haven't seen it play out. We've seen the Bank of England stick with what was kind of most recently hotly anticipated was to be the reduction. But I think there's something else that's really important. I'll just touch on very briefly as to why really this was important today. And that's around GDP. So GDP being, again, the kind of size and health of a nation's economy. And I just wanted to spend a moment talking about the UK's GDP in particular. So I'm putting a slide up here that shows what was the UK's GDP, both in terms of Q3 2024 from a quarter-on-quarter perspective and from a year-on-year perspective. So if you look at GDP for the UK compared to so many other individual countries, or indeed on wider metrics compared against the wider G7, or indeed the wider OECD, which includes sort of a whole variety of additional countries such as Australia, Denmark, Finland. So you've got the G7 comparison and the OECD comparison, and you have to say growth in the UK looks pretty poor. Flatlining zero GDP is not great. So reducing the Bank of England base rate should help, A, give consumers a little bit more money in their pockets potentially, but for businesses, it makes borrowing costs cheaper. And if businesses can borrow more because they can afford more, they've got a bit more confidence, they invest more, so we start to create that cycle of potential growth. So I think really from a Bank of England perspective, when you look at the data and you look at the facts around GDP in terms of that growth or lack of growth, and I finally put in, it's not just about quarter on quarter or year on year. I accept Germany kind of is a standout from a challenge, but aside from that, the UK really challenging GDP numbers. But if you go back to pre-COVID, which is my final slide for today, just to say, actually, well, has, kind of this just happened more recently? Do you know what? This story around GDP has been a really challenging one now for a number of years. Go back to 2019 and look at the growth comparison since then. And still, this puts the UK in a really challenging spot. So I think for today, so many metrics that left the Bank of England with that kind of no real choice but to have that unanimous decision of 72 for the drop. That's what we've seen. Obviously, experts are predicting we might see another 2 or 3 drops through the remainder of 2025. I think a lot of that will depend on what plays out after April with the national insurance increase for employers and, of course, those Trump tariffs. So let's see what happens as a result of today's changes. If you're a borrower and you're not really sure what to do from here, maybe your current product is coming to an end, you're not sure what it means to you, as always, please speak to your mortgage broker for further information. So there we go. That's our new special for the Bank of England base rate announcement for today. Thanks very much for watching. Look forward to seeing you all again soon. Thanks very much. Take care and bye for now.